one of the biggest costs for a homeowner that often doesn't get considered is the opportunity cost of home equity. Maintenance costs, I think they're a lot higher than people sort of appreciate. Across my 12 cities, the average maintenance, depreciation, and renovation expense was 2.66%.
Toronto kind of jumped out at me as a surprise. The renters actually came out 37% ahead.
If you just look at the data, like you look at the chart for Toronto apartment prices, and it's fallen off a cliff. If you're not saving any of that cash flow cost difference, you're absolutely going to be worse off as a renter. And I think that's why renting does get the reputation that it does.
Welcome to The Rent Report by Urban Nation, a podcast where we break down the data shaping Canada's rental and real estate markets. In collaboration with rentals.ca, we go beyond the headlines to unpack the trends, decode the numbers, and explore what they mean across the country. Let's get started.
Hello, and welcome back to another episode of The Rent Report by Urban Nation in collaboration with rentals.ca. Today, we're joined by Ben Felix, Chief Investment Officer at PWL Capital, co-host of the Rational Reminder podcast, and creator of the Ben Felix channel on YouTube, which recently passed 500,000 subscribers. Ben, thanks for joining us.
Thanks for the invitation.
So today we're going to be talking about the most controversial subject in Canada, renting versus buying. Now, this is something I've tried to explain to people quite a bit over the years, but any suggestion that renting can be financially advantageous, depending on the circumstances, seems to be met with very aggressive resistance. And I'm sure you've seen that in your comments section as well.
I sure have.
So I think the first thing that we need to do to introduce the research that you've done on this topic is talk about who it's for and what the underlying assumptions are. Like, who is the homeowner versus renter that you're analyzing in this paper?
I think it's for everyone. And I'll expand on that because there are some limitations. But I think that this information applies to everyone. It'll apply in different ways to people in different situations. And that's where we can talk about the limitations of the way that I have it set up. But as a baseline, like just understanding that renting and owning can be very similar, I think it applies to anyone. And I used apartment data for this analysis just because that's the most readily available data for both rents and prices and maintenance costs, because you can look at things like condo fees and strata fees as part of estimating what maintenance costs are. So that's what I used. I've gotten pushback from people that, well, this doesn't apply to single family homes. I think it does. Like, I don't think that it's a different rental market. It is a different rental market, let me be clear. But I don't think that the underlying economics that are driving the results in my paper are going to be different in the single family home market. So I think it's broadly applicable, at least in general terms. But it is apartment data, so that is worth mentioning. Another big assumption that I make in the analysis is that the renter is not a taxable investor. That's another assumption that I got some pushback on, and it's a valid thing to push back on, and it does change the results if you account for taxes on investment returns for the renter. However, I looked at the numbers and looked at how much RRSP room would the person in my analysis have had if they earned the average income of a Canadian at the time, and they would have had more than enough room in their RRSP and then later their TFSA and then later their FHSA to shelter all of their investments from taxes. If it was a much higher income person that's saving way more than is needed to max out registered accounts, then we would want to factor in taxes. And like when we're doing financial planning for clients at PWL Capital, we are using financial planning software that obviously does take that stuff into account. So that would factor into the decision. And we'll get into how the model works, but in short, one of the biggest costs for a homeowner that often doesn't get considered is the opportunity cost of home equity. And that is going to be higher for a non-taxable investor because non-taxable investment returns are higher than taxed investment returns. So that piece does change. The opportunity cost of home equity does change when we move from non-taxable to taxable. Anyway, the paper looks at a non-taxable investor. So those are really the two big things. We're looking at apartment data. We're looking at a non-taxable investor. And we're starting in 2005. And actually, one other thing worth pointing out: we're starting in 2005. We're assuming that the person is currently renting a place to live. I'll explain why that's important. And they're making a decision about whether to continue renting or to buy. The reason that's important is that the starting rent is not the market rent. It's not the price of going to rent a new place at the time. It is the survey rent, which is the data that we get from CMHC. And that is a weighted average of occupied rents. So the rents people currently living in places are paying, and market rents, which is the rent you would have to pay to rent a new place, which tend to be higher than occupied rents. And so throughout the full analysis, I'm using that weighted average of occupied and market rents. And I am using primary and secondary market rents, again, as a weighted average.
Yeah, that's something that comes up in our own analysis a lot as well, is current rents versus market rents. Like our national rent report is market rents, CMHC is current rents. And people often push back on us about the trends that we're reporting. Like we're saying rent is falling. They're often seeing their rent going up because particularly in rent controlled markets, you would see rents increasing monotonically because there's a typically a spread between current market rents.
Yeah.
Now, to me, the two important assumptions that I want to really make clear before we get into this, which probably seem obvious enough that they don't need to be said to you. But first of all, to do a rent versus buy comparison, you have to be talking about a person who has enough money that they have the option of buying. Otherwise, it's not really much of a choice at all. And the second thing is that on the investor side, the person has to be a disciplined investor and they have to stick to their strategy, right? I mean, it's often said that the hardest thing to do in investing is nothing.
Yeah, for sure. So I do say that in the paper. I don't know why I didn't think to bring it up just now, but it's that is, and this is what I say in the paper, that is probably the biggest assumption in the model is the savings rate. I call it the savings efficiency. And so basically, there's typically a cash flow cost difference between going and renting a place and buying a similar place. You tend to have higher cash flow costs as an owner. And so I model as a baseline a 100% savings efficiency, which means that cash flow cost difference, 100% of it in the baseline case is being saved by the renter. I do look at sensitivity for lower percentages of that savings efficiency. I think I look at 90% and 80%. But I mean, if it's 0%, if you're not saving any of that cash flow cost difference, you're absolutely going to be worse off as a renter. And I think that's why renting does get the reputation that it does, because people imagine that case of just renting and not saving anything. I think in a lot of cases, to your first point, in a lot of cases, people are renting because they can't afford to buy. And those people will not tend to have that excess cash flow that they could have alternatively used to buy a place. And in those cases, like, you're just not going to have anything to save. That's not a savings efficiency issue. That's just you don't have enough income. And so I think that's another reason that renting gets the reputation that it does. My assumption is that the person is renting an apartment. They have enough cash saved up for a 20% down payment on an apartment in the city they live in. I look at 12 different Canadian cities, and they're deciding whether to take that cash and invest it into the stock market. There's another assumption we can talk about. I'm assuming a 100% stock portfolio with a 30% allocation to Canadian stocks and 70% to the rest of the world. So they're deciding, should they take their 20% down payment and invest it in the stock market and keep renting? Or should they take that 20% and use it to purchase a home plus closing costs? So that's the kind of basic setup for the model.
Yeah, essentially what we're looking at is options on what to do with cash flow and also an initial lump sum that you would require for a down payment, right? So
Correct, yeah.
We're examining from an investment perspective. We're looking at a counterfactual, which is an investing term that means just doing something else.
Yeah, exactly.
So yeah, your paper covers from 2005 to 2024, and then recently you released a 2025 update. So can you just summarize what the results were from the paper and then what happened in the update?
Yeah. So from 2005 to December 2024 is the base case. There are a bunch of other assumptions that we didn't really talk about, like there are maintenance costs, closing costs, selling costs. All that stuff is detailed in the paper. We can talk more about it if you want to. I think maintenance costs are particularly interesting, but the model runs through for that full period. And I find in my baseline result that the ending wealth ratio, which is the ratio of renter to owner wealth, that's how I measure the result, on average across the 12 cities is 0.99, ending in 2004. Now, what that means is that on average across these 12 cities, renters and owners were roughly equivalent in ending wealth, with a slight advantage for owners. So renters had 0.99. Yeah, so that's the main finding there. And then when I extended that to 2025 year end, was a big change. So if we think about what happened over that period, real estate has had a rough patch recently, Canadian real estate in particular, and 2025 was no exception. But the stock market has been on a tear. It's slowed down a little bit when we're recording, but year end 2025, it had been on a serious run. And so what I saw when I updated the data was that the ending wealth ratio on average had increased to 1.14. So that means that renters on average across the 12 cities had a higher net worth than owners at the end of 2025. Again, still starting in 2005.
Yeah, and I noticed that, for example, Vancouver, as you would kind of expect, it was still owners that had the advantage due to the massive run up in property prices there and the sort of softer landing that they've had in Vancouver. But Toronto kind of jumped out at me as a surprise, is that the ratio there was 1.37. So renters actually came at 37% ahead. Now, I have a theory on what's going on there, but what did you observe in your analysis that's creating the differentiation between these different results in different cities?
I mean, I'd love to hear your theory. I didn't think too much about why that had happened, other than just general stuff like all of the underlying economics in Canada right now. But if you just look at the data, like you look at the chart for Toronto apartment prices, and it's fallen off a cliff. So you take that combined with the fact that a globally diversified portfolio of stocks has performed quite well, and that's really what's driving the result. I mean, in my paper that ends in 2024, Toronto had an ending wealth ratio of 1.05, so it was pretty close to even, with a slight advantage for renters. But since then, I mean, yeah, property prices continue to tank, and the stock market had a really nice run over the following year, and so that's really what's driving that result. But I'd love to hear your theory about why Toronto has had the outcome that it has.
Well, to me, basically part of it is that Toronto has had an extremely high price to rent ratio for a long time, which is, if you take all the rent you would pay over a year and then divide a home price by that, they often say that around 15 years of rent equals the price of a home is about a balanced market. In Toronto, you would see getting up to 25, close to 30. So even as prices were going up quite quickly and land values were inflating quite a bit, it was still much, much cheaper on a cash flow basis to rent than to own. And in Toronto, there was also a very strong culture of, property prices are going to keep going up. It's a good investment to buy an investment condo, even if you're cash flow negative on it, even if you're, equity flow negative on it, right? Even if your costs are, not even paying for $1 of your equity payment on your mortgage, and you'll just make money on the value increase. So in that sense, Toronto had a very strong bias towards favoring renters through, not just the past few years when prices have been declining, but even through the past 10, 15 years.
Yep, I think that makes sense. And you see that actually in my data too. So one of the metrics I look at in the kind of headline results table in my paper, and it's also in the updated video version too, but it's the average rental cash flow costs over the owner's cash flow costs. And Toronto's, it's not a major standout in terms of being really low for rents, but rents it was 85% roughly is what I found as a ratio. So the cost of renting, the cash flow cost of renting was about 85% of the cash flow cost of owning. And so that difference is what's being saved. But you look across all the cities in my sample, and places where you had really high, like there's one that's super interesting, or two really, are Calgary and Edmonton. So my sample starts in 2005, and the following couple of years, property prices in Calgary and Edmonton and rents shot up. And so what does that mean for my model? Well, it means that the cash flow costs of the owners who bought in 2005 are going to stay low for most of the sample, because they had to take on a relatively small mortgage compared to the cost of housing, which shot up after that.
Yeah, and as you know, those are not rent-controlled markets, so current rents do tend to move with market rents. But what we do see on the flip side is that they are much more responsive in terms of new supply coming to market when that happens. Developers are much quicker to build new purpose-built rentals, especially. And so we're starting to see rents come back down over the past year and a half.
Yeah, interesting.
So we do see typically in Canada, there's a very strong cultural bias towards homeownership, and that's not necessarily a bad thing, but there's also a perception that it's always financially advantageous. People love to say is renting is throwing your money away, whereas owning a home, you're building an asset. But both of us, we've been renters, we're now homeowners. I think we know that there is a lot of money that you throw away on home ownership as well. And you brought up maintenance costs earlier, but what are some of those, non-recoverable costs of home ownership that you have on kind of a month-to-month cash flow basis?
Well, the big ones, and they're not all necessarily cash flow costs, but the big ones are property taxes, maintenance costs, which, I mean, I think they're a lot higher than people sort of appreciate. I found in my paper, I did a sort of a survey of academic literature. I also pulled data from Statistics Canada, both from their CPI calculation and from national accounts data. Oh, and I also cross-referenced that with condo fee data, just to make sure I wasn't like saying a number that's totally crazy. And I found across my 12 cities, the average maintenance, depreciation, and renovation expense was 2.66%.
Really?
Per year.
That's quite a bit.
One thing that I don't think gets thought about enough is that when you look at, because I'm using real estate, like the CREA HPI index returns, and those indices reflect properties improving over time. And some of that's coming from renovation spending, the investment in the properties. And so if we're going to look at that and say, what was the homeowner's return on their home? Well, it wasn't the index return because some of that came from spending that went into it. So we need to estimate what is that renovation expense. Anyways, you add up maintenance, depreciation, which is just like all else equal, an older building is going to be worth less than a newer one, and the renovation spending that's helping to elevate index values over time. And that's where I get the 2.66%. I can tell you, man, as a homeowner, like I wish it was 2.66% for me. Now we bought a house that, in some ways it was unfinished. And so we've been finishing certain things over time, but my spend, we've lived here for 6 years, per year has been way more than 2.66%. So I don't think that gets enough appreciation. Anyway, so it's property taxes, maintenance costs, and then I didn't mention yet the cost of capital, which is, again, this is one that you don't see. It's not a cash flow cost. It's an implicit cost, but it's the cost of having money invested or in the equity of your home and not invested elsewhere. And my elsewhere in my paper is the stock market. Could be something else, but I think just an easy comparable is the stock market. And one of the interesting things about this, and this shows up in the Toronto data that we were just talking about, is that real estate in a country or even in a city is pretty volatile. And that's true at the index level for sure, but even more so at the individual home level. Individual homes tend to be as volatile as the stock market. And they're concentrated in a single place. Like Toronto's a good example where that particular market has had a really rough go recently. But with stocks, you can be diversified very easily. You can buy one fund and have exposure to the whole stock market. It's still going to be volatile, but the sort of idiosyncratic Toronto bad outcome for the real estate market, you can diversify a lot of that away in stocks. Anyway, so that's a cost because stocks have higher expected returns than real estate equity, but there's also a kind of a risk layer to that part of the discussion as well. And then the other piece of cost of capital is the fact that you've got to usually borrow money from the bank to buy the home, and that has an interest cost. So that does also factor into the cost of capital.
Yeah, that's one thing that comes up a lot in these discussions is people say that homes are a better investment because of all the leverage you can get. You can get 5-to-1 or even 20-to-1 on a high ratio mortgage with mortgage insurance. But people very rarely take into account the cost of leverage, right? I saw a video from there's a mortgage broker in California saying, well, people think that a 10% yield on stocks is good and homes only yield 5%. But if you're buying on a 10-to-1 leverage, then you're getting a 5% leveraged yield of 50%. But I looked up the prevailing 30-year mortgage rates in California at the time, and the interest rate was 7%. So that's not a 5% leveraged gain. It's a 2% leveraged loss because you're still paying a fee to maintain that leverage over the course of the mortgage.
Yeah. I did look at just different ways to set up the mortgage in my model to see what effect it had. And in general, I found that shorter amortizations made renting look better. I mean, even if I just back up a little bit, borrowing more generally makes homeowning look better. So that there is merit to that argument, but it's pretty limited. I mean, in the baseline case I had with the 20% down payment, I did actually find that at a 5% down payment in this specific case, the cost of CMHC insurance was enough to make it actually worse in this model. This is the paper, which ends 2024. I have not updated that part of the analysis for 2025. But the ratio gets a little, oh no, sorry, it's a tiny bit better. It's 0.97 instead of 0.99. So at a 5% down payment, you get a tiny little advantage, but a lot of it is eaten up by the CMHC insurance. So it's not like that much better. And then if you have a bigger down payment, because this is, I hear both things, that, you know, leverage is good for homeowners, but I also hear, well, if you own your home in cash, your housing costs are basically zero. But I did look at 100% down payment, so I'm just buying the home outright, and that looks much worse than any amount of leverage. So I think I mentioned this in one of my videos, but it's like, it is true that leverage is is beneficial to homeowners. It is a good thing in general. I mean, it introduces risk too, potentially a lot of risk, but it is generally a good thing if we expect real estate to appreciate over time. It also forces savings, which kind of plays into the discussion we had about the savings efficiency right earlier. But it's not like magic. It's not going to make your outcome so much better that no other investment can compare. It's something that you almost need for you as a homeowner to have a comparable expected outcome to a renter. You need to have the leverage. Not having it makes you look worse, but having it does not give you an advantage.
Yeah, and that makes perfect sense to me, right? If there's a spread between your mortgage interest rate and your expected yield on stocks, then from the way you're doing it in the model, right, you're lowering the homeowner's cost, so you're lowering the amount that the renter would have to invest. The flip side of that, which would be basically equivalent, is you're saying that the homeowner can take that extra cash that they would have spent on their down payment or faster mortgage payments and invest that into the stock market themselves.
Correct. And actually, it's an important point. So in my model, the cash flow difference between renting and owning can turn negative. Mm-hmm. And in that, so that means the cash flow cost of renting is higher than the cash flow cost of owning. And in that case, the renter does start drawing out of their investment portfolio to fund their rent. So in the 100% down payment case, the renter is investing this big lump sum, but then they are withdrawing from it to help support their rental costs. But even with that, it looks quite a bit worse to do no mortgage, to buy the home outright, than it does to use a mortgage.
Yeah. I think also there's kind of an expanded applicability of what you've done in terms of in the model, you're treating a home as an asset that yields a dividend that is perfectly indexed to rent, correct?
Well, no, not really. Like that is a really nice way to think about ownership. And that is kind of happening in the model, I guess. I don't know if it's exactly a perfect hedge, but I do look at, I sorted the data by which markets had the highest rent appreciation. And those markets, probably to nobody's surprise, in those markets, owning tended to look better. And so I do think this is one of the best arguments for ownership, which is, as you just said, that an owned home is sort of like this is a way you can think about it. It's sort of like buying a long-term bond that's perfectly indexed to the cost of consuming that specific home. And what does that mean? Well, it means if housing costs go up in a market, we saw this in Toronto. It's not, now it's gone the other way, but we saw it in Toronto for a while, where the costs of living in Toronto were going up like crazy. Renting, like that was a scary time to be a renter in Toronto. But if you owned, you're hedged against that increase in housing costs because the value of your asset is increasing at the same time. Now that's really valuable if you want to live in a specific house or a specific neighborhood or even a specific city, and you don't want to get priced out of the market. You don't want to get rent evicted, all that kind of stuff. Owning is the way to hedge against that. Hedging cuts both ways though. If the cost of living in a specific housing market decreases, you would expect prices to decrease, which is exactly what we've seen in Toronto. So I really like that argument for owning. If you want to live in a specific place, owning is the way to lock that in. But if you end up wanting to move for whatever reason, you could realize you were taking a whole lot of risk. Like if you bought in Toronto during the pandemic and decided you wanted to move now, well, you had a hedge. You hedged your housing costs, which is cool. But if you want to move to a different market that's uncorrelated to Toronto, like Vancouver, you end up taking a whole lot of, or you end up realizing a whole lot of price risk.
Yeah. And I suppose what I'm getting at with this line of questioning is that, in a sense, this analysis is also analogous to buying an investment property, right? Which is actually an asset that does pay you a dividend, if you will, that's the same as market rent. Setting aside any obvious tax differences and risk differences, of course, as a homeowner, you are not going to decide to stop paying yourself rent, or you're not going to have any vacancy in your own home that you live in. But I think, there's been a perception that real estate is a bulletproof investment as well. And people will go really their whole portfolio into individual investment properties, despite the additional risk and the illiquidity, and the lack of diversification. People see this as a very good asset, but, it seems like they may not be actually capturing any premium for that illiquidity and other risks.
Yeah, I mean, we see that if you just look at real estate funds, public and private. But I think you're correct to say that for rental properties, for individual properties, what I would really like to do, and I just haven't had time to do it, but I can take my data pretty much exactly the way that it is, and I can repurpose it for, I just have to basically switch some columns around and probably account for taxes. But I can look at investment properties because I have rents, I have price appreciation, I have maintenance costs. So I could repurpose these data and do a comparison of, investing in the stock market versus investing in individual, well, I guess in indexes in this case. Individual properties would have a lot more noise around them. But yeah, I think what you said is right. I would love, though, to really kind of hone in on that and actually do the analysis.
Yeah. And, I think that kind of analysis does apply more to institutional investors in real estate, REITs or development corporations that have a portfolio of 1,000 units, things like that. And you can spread the vacancy risk and non-payment risk, things like that, over those hundreds of units. If you only have 1 or 2 units, that can actually become sort of a long tail catastrophic risk. If you have somebody who is in this asset that is a substantial proportion of your net worth, and they decide not to pay for, 6 months, and it takes you a long time to go through the landlord tenant board to turn over the tenancy, that can really throw your investment out of whack for years, if not decades.
For sure. It's just like investing in the stock market. I can model basically index returns for landlords, but exactly, there's a ton of idiosyncratic risk if you have 1, 2, 3, even 4 properties.
Yeah. Now, I guess looping back to the homeownership versus renting discussion, I think people will be upset with us if we don't get into some of these more intangible aspects of one versus the other. We start with maintenance. In analyses that I've done in the past, I typically use 1% as the maintenance cost, which is quite a bit lower than what you were using. I didn't really account for renovations and how those, you spend money on them, but they also increase the value of the property. I've had people push back on me at the idea of 1% maintenance. But the other thing to me that it doesn't really capture is sweat equity that you have to take into account. Even if you're not doing the labor yourself, you still have to organize it. I had an issue with my dishwasher a while back, for instance, and that's something that happened to be in a rental apartment as well. When I was renting, I just called somebody and they took care of it. When that happens in my home, that's kind of my weekend now, is figuring out how to fixing it, and getting whatever parts I need for that. There is, I would say, a substantial time burden to being a homeowner as well.
Yeah, I used to use 1% as well. I changed my mind on that from 2 things. One is going through the data and finding sort of what Statistics Canada is using, what they're reporting in national accounts data, what other academic papers have used as an assumption. But it's not 1%. I mean, it's not. The renovation piece, specifically for this paper, I had to have that in there because I was using real estate index returns as the home appreciation, and those are going to reflect renovation expenses. So that's why I'm at 2.66%. But even if we take that out, it's more than 1% for sure. And then the other thing that kind of changed my mind on that, or solidified my view that it's more than 1%, is being a homeowner myself. And there's like the cash costs, but like you said, the time, as you said, even if you're not the one doing the work, coordinating labor, finding the right people, terminating people that don't do a good job, like it's no joke. It's no joke. It's you are the landlord and the general contractor, and it's basically a part-time job, sometimes more than a part-time job.
Yeah, I mean, you basically take on the job of being the property manager for your own property.
Correct. Yeah.
Yeah. And I guess another one of the often cited benefits of homeownership is security of tenure, which is true. It's you don't have to worry about being evicted from your place as long as you're paying. You can settle down in one place that you like for as long as you want. I think there is a flip side intangible benefit to renting, which is that it is much easier to dispose of a property that you're renting than one that you own. So I think particularly for young people, the ability to move around for different opportunities or different changing life circumstances is a big advantage that we don't really talk about much.
I agree completely. I lived that. My wife and I have 4 kids, and over the course of having 4 kids, we were renting the whole time. We had 4 kids in a rental for a couple of years before we bought a house, and over that period, we would live in a place until it got too small, and then we would go and rent a place that was more suitable for our family at the time. I often hear people say, "Well, when you own, you can do whatever you want to your property." It's like, okay, that's kind of cool, I guess, but when you rent, you can just find a property that better suits your needs, without having to spend all the money on renovations. So yeah, I think that flexibility is huge, and as you said, it's huge for job opportunities if you need to move around the country, or even to a different country. A home, in some cases you can just sell it. In some cases, if it happens to have depreciated in value since you bought it, it might be a little tougher to sell. And just generally speaking, a home does tie you down a lot more. So yeah, I think that's a great intangible. And I agree, that is kind of the flip side of, if you want to stay in a place for a really long time, owning hedges the cost of living in that home, which is awesome if you really want that. But I kind of alluded to this earlier, that hedge can cut both ways, where if you end up not wanting to stay in that place for as long as you had thought, you're taking on a whole lot of price risk that the asset has changed in value relative to what you paid for it, which can really affect your mobility. It can affect how your just financial situation based on how much you can get for the home when you want to sell it. I think another big one that comes up, security of tenure for sure. Another big one that comes up is just like general well-being. People have this view that renters are just miserable people, and that they're like always under the thumb of their landlord and just suffering in their rental. But that may be true in some cases, and I understand that people who have had bad rental experiences would be more likely to want to own, and more likely to comment on my videos telling me about their bad experience. I personally had a generally great experience as a renter. I think there was actually a lot less sort of mental overhead, kind of as we've been talking about.
Yeah, I was so much more relaxed when I was renting an apartment. Now, part of that obviously is, I'm coming from a position of privilege of being able to afford to be choosy about where I lived.
For sure.
So I always tried to go for buildings that were not necessarily fancy, but at least professionally managed.
Yeah, I learned that lesson once. Our first rental was not professionally managed. It was just an individual who had purchased a condo and decided to rent it out. My hunch is not a very experienced real estate investor, and that was not a great experience. They ended up having an issue with the HVAC that ended up being quite expensive to replace, and ended up selling the unit in a bit of a hurry. So that was not super fun to live through, because all the apartment or condo showings and all that stuff. But after that, we did exactly what you said. We got much choosier. We'd only pick relatively nice places, and only places that were professionally managed by reputable property management companies. And for doing that, we had many years of very positive rental experiences. But again, like, as you said, we were privileged to be able to choose places like that.
Yeah, and that's not to say that the smaller mom and pop type landlords can't be good at property management. I think one of the best experiences I had renting was a smaller property investor, but he had been managing a small number of properties for many, many years. And so he was very good about being responsive to requests and listening to my concerns. It's a very easy person to work with.
Yeah.
Whereas I think if you have people who very often in Canada get into property ownership and property investment by purchasing a place for themselves to live in and then moving out into a new place, then they'll say, well, the transactional costs of real estate are so high, it makes more sense just to retain the property and rent it out. Then you start to see a lot more friction.
Yeah. I also looked at, because I knew I had that feeling, that my experience was as we just discussed. But I did look for research on this. There is a paper looking specifically at Canada that shows that there's not a whole lot of, there's no difference between renters and owners in terms of happiness. So like subjective well-being. Statistics Canada has found very similar stuff to that paper when you control for the type of dwelling and the neighborhood. So they do find differences between renters and owners if you don't control for the type of dwelling and neighborhood, which I guess makes sense if you're living in like not that nice of a place and not that nice of a neighborhood. Maybe your subjective well-being would be lower. But when they control for that, they don't find much of a difference. There's also papers using Swiss data that find very similar things. There's a paper that I found that shows that mortgage debt can be stressful basically for people, so that even if homeownership does slightly elevate people's subjective well-being, having a mortgage can offset any of those benefits. Anyway, so it basically just showed that my personal experience feeling pretty happy as a renter is generalizable to a population level.
Yeah. And I also thought your point about renting while you were having kids was interesting. It's often there's sort of a prevailing attitude that it's important to buy a home before you have kids. And people will often try to buy a home for the family size that they anticipate they will have.
100%.
Now, I don't know if you were set on exactly 4 kids when you started your family, or if it just happened, but it's an interesting idea that with renting, you can be flexible with the size of the space you need. And then you could almost buy a place when you're done having kids.
Yeah, I would say it's even more than that. When you're done having kids and know where you want to stay.
Yeah.
That was a big thing for us too. We bought a house when we had found a town that we wanted to settle down in. My company had gone, PWL Capital had gone work from home, and like very firmly committed to that. We hired people all over the country in cities we didn't have offices. So I was very confident we would not go back to in-office, which we have not. And that's been great. But between those factors, we found a place we really liked. We knew I wouldn't have to go back into the office with a pretty high degree of certainty. So we were ready to buy a place that we would live in for a very long time. And we were done. We were sure that we were done having kids. But prior to that, I mean, yeah, we rented, and that flexibility was really nice.
Yeah. So, I mean, really pros and cons to each, both financial, intangible, for lifestyle, for security. I think really, to me, it often comes down to individual circumstances and individual values.
Oh, yeah. Yeah, totally. I hear from people sometimes that say, your maintenance cost assumption is too high because I do all the work myself and I love doing it. So, yeah, that person should for sure own a home.
That's one of the things I do enjoy about it, is that I get the opportunity to do kind of handyman stuff. Although sometimes it does start to feel a bit like I'm constantly behind on it. Although it's not bad to always have a project that you want to work on, but you're never done with the projects.
I do like that stuff. The problem that I have is that I don't have a ton of extra time. And so if I have a project that I know I want to do, or that my wife is bugging me about doing, and that starts to conflict with the time that I need to do stuff like write videos for my channel or do my regular work, that starts to get really stressful. So if I had like unlimited time, doing stuff around the house and improving the house myself would be super fun. And, watching YouTube videos about how to do different things and all that kind of stuff. Conceptually, I like that idea, but it's conflicting with the time that I need to do other work that I also really enjoy and that I happen to get paid well to do. So yeah, I struggle with that one. Like I find home maintenance stressful, not because I don't like the work, but because it conflicts with my time use.
Well, I think we're almost at time here. So speaking of watching YouTube videos, where else can people find you if they want to know more, or if they want to hear more from you?
Biggest place is probably my YouTube channel, just my name, Ben Felix, on YouTube, or my podcast, the Rational Reminder Podcast. We've had some really fun discussions between Dan Bartolotti and myself. Dan Bartolotti is formerly known as the Canadian Couch Potato. People may know his blog.
Oh, really?
Yeah. Dan
Great.
co-hosts Rational Reminder now, but him and I have had really fun discussions around this topic that I know listeners have really enjoyed. So if people want to hear more of this kind of content, they can check me out there. So YouTube, Ben Felix, or the Rational Reminder podcast.
Yeah, and there are, I think you just passed 400 episodes, and I would recommend flipping through them, because if you want anything about any finance, investing topic, there's a good chance there's an episode in there for you, even if you don't listen on a weekly basis.
Yeah, lots of fun. We've actually had some good discussions with academics who have studied this very topic. Eli Bracha was his name. Very, very interesting discussion. Covered a lot of the same kind of points that we covered, but from a very academic perspective. He's done a lot of research on this topic.
All right. Well, thank you so much, Ben, for joining us, and we'll see you next time.
Thanks for the invitation.